Good day, everybody. Hope you're enjoying your day. Um, the other day I talked about kind of painting a little negative tint on the national debt, the U.S. national debt, and I wanted to kind of get the full picture of what's going on, and it's not all bad. It's actually there's actually some good for the national debt, and probably more good than bad as long as it's managed wisely. Um, it's kind of like personal finance. You want to manage your personal finance wisely. If you do a good job managing your personal finance, then you can do really well. And if you don't do a very good job managing your personal finance, then you're not going to do very well in terms of your finances. And so yeah, I kind of I discussed kind of um, some negative aspects of the U.S. national debt. But today I want to focus today on some of the positive aspects of the U.S. national debt and why it's actually a good thing for several reasons. And there's actually like a ton of smart people in the United States government. There's a lot of smart people in the United States, period. And there's a lot of wealthy people in the United States. And part of the reason why they're so wealthy is because of how the system is set up, and people can kind of utilize the system and utilize the markets. People like somebody like Warren Buffett wouldn't have made as much money if he would lived his whole life in Europe as an investor. Just kind of like some of these famous investors. They probably wouldn't have done quite as well outside of the United States because of how the United States system is set up. And so anyway, I'll show you like towards the end like some of the like how the European stock market has done over the last few decades, and I'll compare that to how the United States market has done over the past few decades as well. Um, so there's pros and cons to having there's pros and cons to most things in life, and there's pros and cons to having a relatively high national debt compared to other countries, and so anyway, again, I use some AI here, and I'll go over what I've learned, and go from there. So the question is, what are the benefits of the high U.S. national debt? I kind of label it as high, and then I guess that's kind of new territory. So maybe it's high, maybe it isn't high. But anyway, that was the question I asked. The answer: the core benefit of a high U.S. national debt is that it supports economic activity and financial stability in the short and medium term, even though it creates long run risks. The debt itself isn't inherently good, but the effects of borrowing can produce meaningful advantages. Concise takeaway: the main benefits of high U.S. national debt are economic stimulus, strong global demand for U.S. Treasury securities, and support for financial markets and asset prices, especially during downturns. These benefits exist because government borrowing injects money into the economy and provides the world with safe, liquid financial assets. So, number one benefit: the debt funded spending stimulates economic growth. Government borrowing pushes money into the real economy. This increases demand, boosts corporate revenues, and supports employment. During periods of recession or crisis, this effect is especially powerful. Government borrowing flows into the real economy, raising household income, business revenue, and savings that feed back into investment markets. Stimulus spending during downturns, pandemic programs, for example, lifted consumer spending, corporate profits, and housing demand. Why this matters: debt allows the government to act counter-cyclically, spending when private activity collapses. Number two, treasuries provide safe, liquid assets for global finance. High U.S. debt means a large supply of treasury securities, which are essential to the functioning of global financial markets. Treasuries are among the safest and most liquid investments worldwide, underpinning both domestic and global finance. Foreign governments and central banks rely on treasuries to manage reserves and stabilize exchange rates. Why this matters: the world needs U.S. debt. It's the backbone of the global financial system and supports the dollar's reserve currency status. Number 3, debt supports strong financial markets and higher asset prices. Large deficits often correlate with strong stock market performance because spending boosts corporate earnings and lowers discount rates. Over 15 years, U.S. stocks rose dramatically while federal debt increased from $13 trillion to $36 trillion, partly because borrowing fueled demand and profits. Lower interest rates, often accompanying high debt periods, increase valuation multiples and support housing and equity markets. Why this matters. Debt-driven liquidity can lift asset prices, benefiting investors, homeowners, and retirement accounts. Number 4, borrowing enables long-term public investment. Debt allows the government to fund infrastructure, education, and research that expand future economic capacity. Governments borrow to invest in long-term projects that enhance productivity and growth. Infrastructure and social programs can improve the quality of life and economic potential. Why this matters. Many high-return public investments would not happen without borrowing. Number 5, debt provides flexibility during emergencies. High debt capacity gives the U.S. government room to respond aggressively to crises, wars, recessions, pandemics, financial shocks. Debt reduces fiscal flexibility if it becomes too large, but having the ability to borrow is crucial during crises. Why this matters. The U.S. can mobilize trillions quickly, something few countries can do. Number 6, debt helps maintain the U.S. dollar's global dominance. The dollar's reserve status is reinforced by the availability of deep, liquid treasury markets. Treasury's reliability and dominance in global trade make them foundational to the global economy. Why this matters. Global demand for treasuries strengthens U.S. geopolitical and economic influence. Number 7, debt is normal and often necessary. Nearly every modern economy carries debt. Historically, borrowing has funded wars, infrastructure, and growth. Why this matters. Debt is a tool. The question is not, is debt bad, but is debt being used wisely? Non-obvious insight. High U.S. debt is not just tolerated, it is actively desired by global investors because it supplies the safest collateral in the world. Without large U.S. debt issuance, global financial markets would struggle to function smoothly. So the next question I asked, it's kind of a question that was suggested, and that is how much debt is too much for the U.S. and what indicators signal when the benefits start turning into risks. The answer is key indicators and when benefits turn into risks. Here's the short version. Debt becomes too much not at a single magic number, but when interest costs grow, growth, and market confidence start to visibly strain. Think of it as a dashboard, not a cliff. Snapshot table. So we got a chart here, the indicator, what to watch for, and why it matters. Indicator, debt to GDP ratio, what to watch for, sustained risk above prior peaks, 100% and plus and climbing, why it matters, signals growing burden versus economic capacity. Indicator, interest cost as percent of GDP, what to watch for, moving toward a 4 to 5% plus of GDP. Why it matters, crowds out other spending, raises risk of crisis. Indicator, interest costs as percent of revenue, what to watch for, 20 to 25% plus and rising. Why it matters, taxes increasingly pay for past, not present. Indicator, primary deficit. Example, interest. What to watch for, persistent deficits even in good times. Why it matters, shows structural imbalance, not just cyclical. Indicator, market behavior, yields, auctions. What to watch for, sudden yield spikes, weak demand for treasuries. Why it matters. Early warnings of confidence problems. So we're looking at key indicators and when benefit turns into risk. Number one, debt to GDP, high and rising versus high and stable. Current trajectory. Publicly held U.S. debt is projected by CBO to rise far beyond historical records, reaching around 166% of GDP by 2054 if laws don't change. Historically advanced economies start to face heightened risk when debt is well above 100% of GDP and still on an accelerated path, especially if growth is not strong enough to stabilize it. Risk signal. High debt isn't fatal by itself. It becomes dangerous when debt grows faster than GDP for many years, making stabilization politically and economically harder. Number two, interest burden. The clearest too much signal. Two key ratios. Interest as percent of GDP. CBO projects net interest outlays rising towards 4 to 5% of GDP over coming decades. Interest as percent of federal revenue, projected to reach about 26% of revenue by 2036, meaning more than a quarter of tax dollars go just to interest. When interest costs grow faster than the economy, consistently outpace spending on core priorities, defense, investment, and safety net, the benefits of debt, stimulus, safe assets, flexibility start to flip into crowding out, vulnerability to rate shocks, and political stress. Risk signal. You're in the danger zone when a large share of every new borrowed dollar goes to interest, not to useful spending. CBO estimates roughly 2/3 of new borrowing over the next decade will go to interest alone. Number three, primary deficits. Are we at least paying for today? A primary deficit is the deficits excluding interest. CBO projects persistent primary deficits large by historical standards over the next 30 years. If a country runs primary surpluses, it can slowly work debt down even with high interest. If it runs primary deficits in normal times, it's signaling that the fiscal stance is structurally loose. Risk signal. Debt becomes too much when the government cannot or will not move to primary balance even in good economic conditions, meaning the default setting is borrow more every year. Number four, market confidence, the invisible line. There's a soft threshold where markets start to question sustainability. Rising yields not explained by inflation or growth, but by a fiscal premium, investors demanding extra return for perceived risk. Signs of treasury market fragility. Examples, stressed liquidity, heavy reliance on leveraged players, or weaker foreign demand. So far, the U.S. still enjoys strong demand for treasuries, but IMF and others warn that erosion of the convenience yield, the special safety liquidity premium of treasuries, would raise borrowing costs and reduce the benefits of high debt. Risk signal. Watch for sharp, persistent increases in treasury yields, failed or weak auctions, and growing talk of fiscal risk premium. Those are early signs that markets are starting to price in concern. Number five, fiscal space. Can the U.S. still respond to shocks? Too much debt also means too little room to respond to future crises. CBO and independent analyses emphasize that rising debt reduces fiscal space, the ability to deploy large stimulus or emergency spending without triggering market stress. Risk signal. When policymakers start openly worrying that another big shock, war, pandemic, financial crisis, would be hard to finance without destabilizing markets, you're seeing the practical limit of debt benefits. So is the U.S. already past the safe zone? Direct answer, based on current data, the U.S. is not in an immediate solvency crisis, but it is on a clearly unsustainable long-run path if current laws persist. Debt is already at post-war record levels relative to GDP, and interest costs are projected to become one of the largest line items in the budget, exceeding defense and rivaling major programs. In other words, the U.S. is in the zone where benefits still exist, safe assets, flexibility, stimulus, but risks are no longer theoretical. They're showing up in projections for interest costs, fiscal space, and market fragility. So then I was curious and I asked who owns or holds the U.S. national debt? Because some people make assumptions that may not be true. And the answer is the U.S. national debt is not owned to one entity. It's held by a wide mix of domestic investors, foreign governments, the Federal Reserve, and federal trust funds. The most recent data from 2025 to 2026 shows a clear pattern. Most U.S. debt is owned by Americans, not foreign countries. Below is a structured, evidence-based breakdown using the latest Treasury, Federal Reserve, and TIC data. Citations appear throughout. Number one, the big picture. Two types of debt. The 39 trillion gross national debt splits into two categories. Debt held by the public, which is 80%, owed to investors outside the federal government. Intragovernmental holdings, 20%, owed to federal trust funds, like Social Security. Publicly held debt is the economically meaningful part because it reflects borrowing from actual creditors. Number two, who holds U.S. debt? Complete breakdown. Domestic holders, 76 to 81% of the total. Domestic investors are by far the largest creditors. Now it provides a table. I got to call them holder, amount, and share. And then they give sources. The holder, Federal Reserve, they hold 4.4 to 4.6 trillion, and the share of the debt is 11 to 13%. Mutual funds, amount is 4.2 trillion, share is 11 to 17%. A holder, private pension funds, amount is 1.0 to 1.1 trillion, and the share is 3%. Holders, banks and depository institutions, amount they hold is 1.7 to 1.9 trillion. The share is 5%. Holders, insurance companies, amount they hold is 0.4 trillion. Share is 1%. Holders, state and local governments, amount 1.7 trillion. Share 5%. Individual investors and other domestic, amount 5.7 to 6.7 trillion. Share 15 to 19%. So that'll be people like me and people like anybody who anybody who holds money in money market funds, or any type of like treasury bills, T-bills, that sort of thing. Domestic private investors, mutual funds, pensions, banks, households collectively hold 26.6 trillion, or 69% of all federal debt. B, foreign holders, 24% of total. Foreign governments and investors hold about 9.2 to 9.35 trillion. Top foreign holders, 2026. Gives a table with columns for country, amount, and notes. Country is Japan. Amount is 1.21 trillion. Notes, largest foreign holder. Japan is the largest foreign holder of U.S. national debt. United Kingdom is now number 2 with 0.94 trillion. China, number 3, 0.65 to 0.76 trillion. And that's down from 1.3 trillion at peak. Country, Cayman Islands, amount 0.47 trillion. Notes, custodial financial center. And other countries combined hold 6.4 to 6.5 trillion. And notes on that are global central banks and funds. Foreign ownership has grown over 25 years but declined as a share because domestic investors have grown even faster. C, intragovernmental holdings, 7.6 trillion. That's 20%. These are federal trust funds that hold specific issue treasuries. And it gives a chart with columns for trust fund, amount, and purpose. And for trust fund, it's Social Security Trust Fund. Amount is 2.6 to 2.7 trillion. Purpose, retirement benefits. Trust fund, Medicare trust funds. Amount 0.3 to 0.4 trillion. Purpose, hospital and medical insurance. Trust fund, military retirement fund. Amount 1.1 trillion. Purpose, military pensions. Trust fund, other federal trust funds. Amount 3.4 to 5.1 trillion. Purpose, civil service, retirement, etc. These are internal IOUs, one part of the government lending to another. The key insights. Number one, most U.S. debt is held domestically. Across all sources, domestic holders own roughly 3/4 of the total. This contradicts the common myth that China owns the U.S. Number two, China is a small holder today. China's holdings have fallen nearly in half since 2013. Japan and the UK now hold more. 3. The Federal Reserve is a major holder. The Fed owns 4.4 to 4.6 trillion, accumulated during quantitative easing. It is now reducing holdings via quantitative tightening. Number 4. Social Security is a major creditor. The Social Security Trust Fund holds 2.6 to 2.7 trillion, but these services will begin declining as benefit payments exceed payroll tax revenue. All right, so that's the more positive approach to the U.S. national debt, and I'll also show you how it says stimulates economic growth. Treasuries provide safe liquid assets for global finance. You have people all over the globe that invest in the United States. Debt supports strong financial markets and higher asset prices. Borrowing enables long-term public investment. Debt provides flexibility during emergencies. Debt helps maintain the U.S. dollar's global dominance, and debt is normal and often necessary. So what I'm gathering is that having some debt is not inherently a bad or good thing, but if it's used wisely, it can be a good thing. And I'll show you I'm involved in the U.S. financial markets, and so I'll show you how it can be a good thing in the financial markets. And I'll show you because the other day I discussed some of the some concern over how some of the wealthier European countries don't use as much debt, and structurally it's built into so that they can have as much debt as the United States has. And but we'll look at the in terms of their financial markets and see how that plays a role. So I looked at three different ETFs, and you can buy these in the United States. But one of them is it's called VGK. And they're all from Vanguard. I don't know why I picked Vanguard, but I was trying to find something to where I know the ticker singers for two of the three of them. I didn't know that. I'm kind of new to this one here, but I wanted to kind of compare and contrast some of the market performance for European stocks compared to the U.S. stocks over the last 10, 20 years. And so the VGK is Vanguard VTSE Europe ETF, and it's holds a very broad basket of 1,233 European stocks as of May 31, 2026. And so it's got over 1,200 stocks, and it's got different names from different countries, but all in Europe. And it shows you some of the country exposure. United Kingdom is number 1, Switzerland 2, Germany 3. It's kind of got exposure from many countries around in Europe. And the sector breakdown: financials, industrials, and healthcare are the top 3 sectors. 23.9% financials, industrials 19.9%, healthcare 12.4%. So we'll look at the chart. And this isn't the first time this is done. Okay, there it goes. All right, so I want to look at a long term. So this actually goes back to like 4/29 of 2005. So it goes back over over 21 years. And as you can see, all time, it's increased 79.78%. at least according to this chart. And I looked at this on another, maybe it was Yahoo, and they had, it's similar, like, but it's gone up, about that same amount, and that's over the course of, like I said, over 21 years. So now we'll look at how that how that compares to. Let's see here. We'll look at how that compares to some of the to VTI, and VTI is a another ETF from Vanguard, and it is U.S. Total Market Index, holds about 3,400 plus stocks, spanning mega caps like Apple and Nvidia all the way down to micro caps. So it's got big, it's got large cap, mid cap, and small cap stocks. And you can see some of the big names, and these are all American companies. Top 10 concentration is 33 to 35% of the fund. And the technology breakdown is a bit different. Technology is by far the biggest, financials second, and consumer cyclical is third. So we'll look at chart, and we'll go max. And so this is, like, I guess if you started it about 2005, 56, all the way up to 369 today. So it starts a little bit sooner, but all time, I mean, about 4 years sooner, but all time goes up 544%. And that is, like, in the United States, we kind of had like a lost decade in stocks, and from like 2000s, there was not much happening here. You had the dot-com bubble in the early 2000s, and then the Great Recession here, and there just wasn't much return. And then after the Great Recession, then there was, things have gone quite well in the U.S. markets. So that's obviously done very well in the same time frame, comparatively. And then we'll look at, just for fun, we'll look at the VU. And the VU is the Vanguard S&P. This is the S&P 500. This is the 500 of the largest U.S. companies in the world, or 500 of the largest U.S. companies. So this is, it's kind of similar to the top companies of the last one. 35 to 39% of the fund confirmed across multiple sources. Has all, like these top 10. And then these are these big, most of these tech companies. And sector breakdown, technology, financials, and consumer services are the top three. And those sectors are the bulk of the S&P 500 right now. So we'll look at the chart on that, and it's actually quite similar to the VTI. This one started a little bit later, apparently. This one, October 29, 2010. At least according to this chart. I don't know exactly when the thing started. But according to this has gone up 557% all time. Started at 108 on October 29, 2010. And now it's at 695.49 on May 29, 2016. So obviously, if you look at these charts, like what I'm seeing is that you got like, like if this information I'm getting is correct, and not all, like sometimes I get some incorrect information, but generally the AI, gathers information from all over the internet very quickly, and most of it is pretty accurate. Like sometimes it's not 100% accurate, but it's fairly close to being accurate. And so if number 3 is correct, debt supports strong financial markets and higher asset prices. I should be happy, and anybody west in the stock market should be happy that there's or globally should be happy that the United States um, utilizes higher debt relative to other countries in the world, and there's obvious benefits to that. And so anyway, I just thought I'd share that, like, because I do like the other thing. It seemed like it was kind of a negative tint on the U.S. national debt, and turns out it's actually kind of good in many ways, but it just has to be used wisely. That's what needs to happen. So anyway, yeah, hope it's somewhat helpful, and I hope you enjoy your day. All right, take care.